Hi, my name is Jake and welcome to my YouTube channel. In this video, I want to share my thoughts on the importance of diversification by sharing video clips of Warren Buffett and Ray Dalio speaking about their own opinions on diversification and the lessons we can learn from them. Diversification is a common investing method to reduce risk and maximize return by allocating assets into various types, categories, or products that will react differently to the same incident. You might have heard the phrase, "Don't put all your eggs in one basket," common advice to spread out the risk for someone that concentrate all of their resources in one area. However, a legendary investor, Warren Buffett, is not a big fan of diversification because he believes that if you truly understand what you own and why you own it, then you should never have to diversify because it can reduce overall return.
But once you're in the business of evaluating businesses and you decide that you're going to bring the effort and intensity and time involved to get that job done, then I think that diversification is a terrible mistake to any degree. And if you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money. And I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea. But a lot of people gotten rich on their best idea.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you really got to grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one the rest of your life, you would think a long time before every investment decision.
We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and it's a confession in our view that you don't really understand the businesses that you own. I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. If you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses.
I see many retail investors buying the most hyped stocks without ever reading the annual report or understanding the company's fundamentals in hopes of quick, easy profits. However, if you don't understand what you own and why you own it, you will never win in this game because you will not have the mental stability to handle the frequent market volatility, in which you will most likely end up buying when the price is too high and sell when the price is too low. If you've done your homework, understand the company, and very confident in your analysis, then you could potentially identify, estimate, and differentiate if the current stock price is either a buy or sell opportunity. On the other hand, the world's largest hedge fund manager, Ray Dalio, believes that in order to maximize and reduce the overall risk on your portfolio, you must diversify your portfolio by holding non-correlated assets, and he refers to this unique method as the holy grail of investing.
Risk and the number of sample size and the correlation of the bets, broke it down to each of its components, right? So to use an example, let's assume you have, to make it simple, a return, something that has a 10% risk, we'll call risk standard deviation. And let's make it simple, and let's say it had a 10% return. And let's say I add in another asset, another return asset, return stream. I add in a second, a third, a fourth, a fifth, up to whatever number. How would that reduce my risk if it on average has a 60% correlation? Or if it has on average has a 40% correlation or a 0% correlation? How would that change? Wanted to know that, right? So that's what this chart shows, right? And so, so imagine you have a 10% average return. You don't know which bet is going to be better. Has a 10% average return and a 10% risk. And you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe is about 15%. And you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows, okay? And it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic is you only need to do this simple thing. The simple thing is to find 15 or 20 good uncorrelated return streams. Things that are probably going to make money, but you don't know, but they have a good probability of making money, and that are uncorrelated, that have low correlation. That told me that's what I have to go after, right? That's the key. A lot of people think that the most important thing you could do is find the best investments. Okay? That's important, okay, but there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5, right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably, nobody's humanly capable in an efficient market probably to pick investments that are 5 times as good individually, but so that path. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. You know, like if I can get zero correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%, okay? As distinct from 40% with any one of us. So that's the power of portfolio construction and the power of diversification, okay? So it tells me what I have to go after.
Many retail investors assume that investing in stocks in many different sectors, such as energy, tech, healthcare, and financials, are safe enough. However, no matter what sectors you invest in, stocks are always going to be highly correlated with other stocks. Therefore, by holding non-correlated assets from stocks such as bonds, cash, commodities, gold, or real estate, you won't have to sacrifice the overall return on your portfolio based on a single event and continue to generate an overall return on your portfolio. At the end of the day, it is up to individual on which method to consider based on the personal risk level. But I combine both methods to diversify my portfolio by limiting my positions by only investing in companies that I think are truly revolutionary and have the potential to disrupt how we all live in the future, and also invest in different asset classes such as real estate, Bitcoin, or gold based on a certain amount of my overall portfolio value. Before I buy any stocks, using my imagination and creativity, I researched what the future society would be like based on the current economic movements, political trends,
China, 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 China,
and technological shifts. Then I try to find companies that fit within my overall research and study the company's visions, plans, financials, and the business model until I fully understand and very confident in my analysis. When you really dig deep and try to find companies that are highly innovative, not only it is very difficult, but there aren't that many. If you think about when Apple released its first iPhone back in 2007, it was truly revolutionary and there was nothing like it in the market at the time. Apple changed not just the IT industry standards, but also how we all live and interact with the society. This is how I limit over diversification by narrowing down to very few companies that I think could potentially change the world. Also, I invest in real estate rental properties that generate consistent cash flow regardless of what the current economic situations we're in. Even though real estate won't generate high returns like in the stock market, but if you're able to find a property with a great deal and location, it is absolutely a recession-proof investment by producing consistent cash flow. Lastly, I like to hold at least 10 to 15% of my overall portfolio values into Bitcoin or gold to hedge against inflation to offset the risk of any economic downturn. There are many strategies for diversification, and this is just my own approach to reduce overall risk and maximize return for my portfolio. I am usually very bullish and optimistic when it comes to investing due to my personality, but also the archetype of the Fed's behavior when it comes to the monetary policy, and the US's strong economy and reserve currency status. However, it never hurts to always be cautious, observe the situation rationally, and diversify to protect your investment because the future is always going to be full of uncertainty. I hope that this video was helpful, and if you like this kind of content, please give it a like and consider subscribing for more upcoming videos. Thank you for watching.